Financial Reporting Through the Lens of a Property Casualty Actuary. Chapter 22, U.S. GAAP, Part 2. Goodwill under purchase accounting. Under SAP, a business combination is accounted for either as a statutory purchase or a statutory merger. Business combinations that create parent-subsidiary relationships are accounted for as a statutory purchase. Alternatively, transactions are accounted for as a statutory merger if equity of one entity is issued in exchange for equity of the second entity, with the equity in the second entity then canceled. Prospectively, only one entity exists. Under statutory purchase accounting, the assets and liabilities of the acquired entity are recorded at their historical carrying, i.e. book, values. Goodwill is calculated as the difference between the purchase price and the net book value of the acquired entity. Goodwill is limited in the aggregate to 10% of the acquiring entity's capital and surplus, adjusted to exclude any net positive goodwill, electronic data processing equipment, and operating system software, and net DTAs for its most recently filed annual statement. Goodwill is amortized to unrealized capital gains and losses over the period in which the acquiring entity benefits economically, not to exceed 10 years. Under U.S. GAAP, all business combinations are accounted for using purchase accounting, which requires all assets and liabilities of the acquired entity to be recorded at fair value, including all identifiable intangible assets. Goodwill represents the difference between the purchase price and the fair value of the net assets of the acquired entity. Goodwill is not amortized, but is evaluated for possible impairment on a regular basis. For example, Company XYZ acquired Company ABC, an insurance entity, on January 1, 2018. We assumed that the purchase price of Company ABC was $3 million. The fair value of Company ABC's net assets was $2 million, and the statutory surplus amount of Company ABC was $1.5 million. On January 1, 2018, we calculated that under SAP, the goodwill recorded should be $1.5 million, the difference between the purchase price and the statutory surplus of Company ABC, and that, under GAAP, the goodwill recorded should be $1 million, the difference between the purchase price and the fair value of the net assets. On December 31, 2018, we calculated that under SAP, the goodwill recorded should be reduced to $1.35 million after amortization, assuming the goodwill should be amortized over 10 years, and that under GAAP, the goodwill recorded should remain at $1 million as no impairment was identified. In the case of a negative goodwill, under SAP, it should be recorded as a contra asset and be amortized to unrealized capital gains and losses over a period not to exceed 10 years. Under GAAP, the negative goodwill should first offset the book value of the acquired non-current assets, plant, property, equipment, intangibles, and other non-current and non-monetary assets, and the residual negative goodwill recorded as a bargain purchase gain through the income statement. Due to these different approaches in calculating goodwill, the initial amounts of goodwill under SAP and GAAP can be significantly different. Chapter 23, Fair Value under Purchase GAAP, will discuss further the concept of fair value in business combinations. SEC reporting. Companies with publicly traded securities are required to file quarterly, Form 10-Q, and annual, Form 10-K, financial reports with the SEC. In addition, companies are required to file a Form 8-K on an ad hoc basis for material events as they occur. The triggering events requiring the filing of an 8-K include a change in the principal officers or directors of the company, a change in the company's certified accountant, and entering or terminating a material definitive agreement. These filings provide investors with quantitative and qualitative information about a company's business and operations, allowing investors to make informed and timely decisions. The key contents by section of a 10-K include Part 1, Business Description, Risk Factors, Unresolved Comments from SEC Staff, Property, and Legal Proceedings. Part 2, Financial Statements and Supplementary Data, Selected Financial Data, Management's Discussion and Analysis of Financial Condition, and the Results of Operations and controls and procedures. Part 3. Directors and executive officers of the company, executive compensation, securities ownership by certain beneficial owners and management, certain relationships and related transactions, and the fees of the principal accountant. Part 4. Reports, exhibits, and schedules from 8Ks filed during the reporting period. The 10Q is an abbreviated form of the 10K. SEC reporting requirements for all registrants are mainly outlined in 2 regulations. 1. Regulation SX, Form and Content of Financial Statements. And 2. Regulation SK, Integrated Disclosure Rules. Regulation SK contains general instructions to all companies around the composition and presentation of financial statements. Specifically, Article 7 provides detailed rules around the form and content of financial statement data and schedules of insurance companies. Many of these requirements are also required under GAAP. In particular, Article 7 requires the insurance company to state in the notes to financial statements the basis of assumptions, including interest rates, for determining discounted liabilities, deferred acquisition costs amortized in the period, statutory stockholders' equity and net income or loss. In addition, Regulation SX requires certain schedules to be included in each registrant's 10K form, their annual filing. These schedules include Schedule 3, supplementary insurance information for each reporting segment, of which the following is required to be reported: deferred policy acquisition costs, unpaid loss and loss expenses, unearned premiums, other policy claims payable, premium revenue, net investment income, losses and loss expenses, amortization of deferred policy acquisition costs, other operating expenses, premiums written. Schedule 4, reinsurance, including amounts ceded and assumed. Schedule 6, supplemental information concerning property casualty insurance operations that includes the same information as Schedule 3 in total across fiscal years for the current fiscal year and the 2 years prior. Following are examples of Schedule 3, Table 104, Schedule 4, Table 105, and Schedule 6, Table 106, from a 2018 10K filing for a company we are calling Fictional Insurance Company. Regulation SK contains the requirements for the non-financial statement portions of the 10K filing. In conjunction with the Securities Act Industry Guides, Guide 6, disclosures concerning unpaid claims and claim adjustment expenses of property casualty insurance underwriters, the following items are required to be disclosed: a tabular analysis of changes in aggregate reserves for unpaid claims and claim adjustment expenses for each of the latest 3 one-year periods. Method for estimating the effects of inflation, implicitly or explicitly. A reconciliation between statutory and GAAP reserves for unpaid claims and claim adjustment expenses, including an explanation of the key differences. The amount of discount embedded in the GAAP reserves for unpaid claims, including the pre-tax income effect of discount accrued and of discount amortized. The following is an example of the tabular analysis of changes in aggregate reserves. Table 107 shows for each of the last 3 years the beginning reserve from the prior year end, the provision for reserve development in the calendar year, ultimate incurred losses from accidents occurring in the current year plus change in ultimate incurred losses on accidents from prior fiscal periods, paid losses, and the ending reserve. The beginning reserve plus the provision for reserve development minus paid losses equals the ending reserve. If the company makes an acquisition, this would be reflected in the beginning reserve balance. Accounting Standards Update, ASU, 2015-09. In the early 2010s, the FASB explored a joint project with the International Accounting Standards Board, IASB, to update insurance accounting. Due to a lack of agreement between the boards, The FASB decided instead to make targeted improvements to the current accounting under US GAAP. Meanwhile, the IASB went on to develop IFRS 17. See Chapter 24. The FASB initially proposed that short-duration contract liabilities be discounted to allow investors the ability to understand the present value of the liabilities, but with no adjustment for risk. Insurance companies and the analyst community provided feedback indicated that any discount would immediately be unwound by analysts to be replaced with what they believe is the appropriate amount of discount. Instead, the analysts requested additional disclosures to be developed to allow them more insight to develop their own discount and to judge management's ability to establish the appropriate reserves estimates over time. The resulting guidance that was issued in ASU 2015-09 added several new disclosures to US GAAP financial statements for short-duration insurance contracts. The key elements of ASU 2015-09 are as follows. The reserve roll-forward table, required annually by the SEC, see Table 107, was codified into US GAAP and required quarterly for all US GAAP financial statements, rather than just annually for SEC public filers. Accident year triangles of paid and ultimate loss and LAE for up to 10 years on a net of reinsurance basis. These triangles were required to be reconciled in another schedule to the carried reserves. Current reported claim frequencies and the current net loss and LAE IBNR by accident year on the same level of aggregation as the triangles. A description of the methodologies used to estimate the loss and LAE IBNR. The average annual payout of ultimate incurred claims based on the paid triangles, and current ultimate incurred loss and ALAE. In the aggregate, a description of any significant changes in the methodology used to estimate the IBNR, or the reported claim frequencies. These additional disclosures were required to be presented at a level such that useful information is not obscured by either the inclusion of a large amount of insignificant detail or the aggregation of items that have significantly different characteristics. The exceptions to this requirement were the quarterly roll forwards and the description of significant changes in methodology, both of which are only required in the aggregate. While there are similarities to the triangles in Schedule P for some of these disclosures, there are also important differences. Some of these differences include: these US GAAP triangles require ALAE, not DCC. For example, this can drive significant differences if claims are handled by external adjusters, whose costs would fall under ALAE for US GAAP as long as they can be allocated to a specific claim, but A&O expense for SAP. The level of disclosure for the US GAAP triangles is principle-based, while SAP has defined lines of business. Schedule P, even when presented for a group, only contains business written through U.S. entities for an insurance group. The U.S. GAAP disclosures may require business written globally, which can lead to significant foreign currency exchange issues. Under U.S. GAAP, the IBNR and reported claim frequency are as of the financial reporting date, and not in triangle form. The former limits the ability for a user of the financial statements to obtain and use case-incurred data. The latter, while meant to help the user understand the severities in the underlying business, ignores that incurred amounts for reported claims tend to develop after being reported, and claims reported later tend to have higher severities. Therefore, care must be taken by users in interpreting these disclosures. The American Academy of Actuaries published a white paper on the considerations in implementing ASU 2015-09 in December 2016. In developing the white paper, the authors consulted with the AICPA's Insurance Expert Panel and the SEC. Therefore, the reader is urged to read the white paper for further information.